Okay. Get started in a bit. Markets just a little bit calm at the moment. Everyone waiting for Nvidia, perhaps? Maybe so. Lots of other stuff going on as well. See Bitcoin's back down below that magic 70,000. Wonder if that'll hold. Obviously, Coinbase driven by that. Tesla had a little bit of a bid today. Just out of nowhere, popped up to 182 last time I looked at it. 180, 181. Be interesting actually if that holds. Trades back below the 180. It's been in it's been jammed between sort of 172 and a half and 180 for several days now. So that needs to resolve one way or another. It's been so weak relative to the NAS. And so unloved, just like Roku has. Zoom to a certain extent. So funny how these just rotates all the time. This rotational, sector rotation is alive and well. Always has been. I think it always will be. We'll get started any moment, ladies and gents. We'll give it a few more minutes. Not so many today. Maybe the sun's out. Maybe you will trading away. Coffee's got a bit of a bid. Got my eye on some of these commodities at the moment. Having seen cocoa take a rip, which is who the hell trades cocoa? No one. And all of a sudden it's just ripping to the highs. I think that there's a gold obviously holding near highs. I think it's commodities may come back in fashion. I mentioned natural gas a couple of months ago, just coming off those lows. It's got a real relentless bid at the moment. Interesting to see if that can really get going. That's got a lot of potential upside if it does. It's funny, it's sort of counterintuitive when we had all the economic, or should I say headwind, or should I say tailwind should be for natural gas. It should have been spiking. When we had the Russia invasion, all that didn't really get going, which I think caught a lot of people out. But now it's kind of chugging along, almost like it kicked into gear in the 1st of May. Just literally, bonk, May came in and everyone was buying. Okay, so I'm going to get started any moment. I want to make sure I'm getting started on the button to allow everybody to get in. It's going to be an interesting one today. Looking forward to this one. And make sure everything is off. Don't need disturbances. What else we got ripping? Not much. FTSE's little spring pattern on FTSE. You guys who like to trade Wyckoff, that daily's just set up a little spring. I've not looked at FTSE for ages. It's not something I've traded for so long. But yeah, big ripper. Since it broke through that 8,000, it's just pulled back and then boom, just like a rocket. A few days pull back, 8,100, and then it's just ripped to 8,400. Bit late for a spring, possibly. You've got to be careful. You've got to look at things in context and go, hang on a second, this is not at the end. This is not the beginning of a move. This is more towards the end. How much meat is really on the bone? Little questions like that have to be asked. Okay, let's get started, ladies and gents. All right, first of all, I do want to apologize for the technical issues we had last week. It happens, and I just want to say sorry if you were here waiting for the webinar to start and it didn't start. I apologize. But good news is today we're going to mix them together. So I'm going to do day trading, I'm going to do swing trading strategies. I'm going to try to fit everything in within the hour. If I overrun a touch, I don't mind. Of course, you're welcome to leave. I know you've segmented off an hour in your calendar. So if I overrun a little bit, I'll try to keep it within the hour. But if I overrun a little bit, of course, you will get a copy of the recording. I want to make sure I get all the content I've prepared from last week and this week together. I've got rid of some of the screenshots. I've got rid of some of the bits. Of course, you can always ask me questions about this at any point. You can send me an email, support@tradersmastermind.com. That will get to me. I've got a guy managing my inbox there, but it will get to me. If it's a good question, I'll absolutely help you out there. Okay, so first of all, let's just, of course, talk about the disclaimer. Please be aware, spread bet, CFD, etc. Super risky, high risk, especially if you're trading with leverage. 75.2% of retail investor accounts lose money when they're trading spread bets. So just bear that in mind. Okay, bear that in mind. High risk, high reward. I have to say each time, because I appreciate there's people with different levels of experience on here. And if you don't understand the product, learn the product first before you decide to take the leap. If you understand the product, then great. You're all aboard. You understand the nature of the beast. Right. Let's go. Trading earnings. So, talking about Wyckoff, the market does not beat them. They beat themselves because though they have brains, they cannot sit tight. How many times have we heard this? So often. Jesse Livermore, Paul Tudor Jones, all these people talking about patience. And really, this is really relevant today with the earnings topic because trading earnings is all about being patient, waiting for your setup, whether that is the day trading momentum ignition setup that we'll cover, whether that's a day 1, 2, 3 swing play that again we're going to cover. It's all about being patient, picking your moment, picking your opportunity, and taking the trade. Just going for the trade, managing the risk, capping the risk. Okay, so why this has come about is, which is great. This is a topic that I really, really, really enjoy. I like trading this type of methodology. And Pepperstone recently have announced they're doing 24-hour CFD trading on selection of US shares. So it's a great time for me to be able to say, okay, listen, let me share some of the things that I think are worth looking at. And obviously, with this new offering from Pepperstone, you get to take advantage potentially. It's high risk. We'll talk about the risk in a moment, and trading some of these products. So great timing. And I thought, oh, that's perfect. I get to talk about something that I really, really, really like to cover. Okay, so reminder, I don't have all the answers, guys. I'll share with you ideas and thoughts. I've been training a couple of decades, but I don't know everything. I will share with you things that I think are relevant and useful, things I've seen from other people. But do your own analysis, do your own research, do your own homework. Of course, any of the setups I share, strategies, ideas that I share, you use them as a seed to go and investigate yourself. That's how things like this should be used. Whether it's my content, whether it's someone else's, that's I think how you get good. Is it sparks an idea and you say, okay, that's interesting. Let me go and discover. Let me do some back testing. Let me do some forward testing. Let me play around with that idea and make it my own. That's how you really build your own earnings playbook. Things take time. Implement the change and stick to it. Observe the results, and of course, make those little course corrections after you stick to it for a while. Make some course corrections, adjust and tweak. By the way, there is a Q&A section if you want to put your questions in that. I'll get to that at the end. Hopefully we'll have time for that. So I'm trying to mix these two webinars together, but I'll do my very best. If I don't get to a question and I think it's something that I haven't answered, then I'll definitely try and get to it. Okay, so let's go. Earnings trader. So earnings season begins 2 weeks after the end of the quarter. So you've got January, April, July, and October, and lasts for about 6 weeks. So you have these 4 points in the year. You have January, April, July, and October, where you can really become a specialist in trading earnings. And why I think earnings are a great place to focus on, or a great strategy to maybe complement your existing day trading strategy or swing trading playbook, whatever you kind of do, whether you're trading the NASDAQ, whether you're trading currency pairs, whatever. I think it's something that can complement it initially, can run it in parallel, and you might find it's something you like to do. Why? Because it's kind of a sprint then rest workflow style. So if you're trading, you can go, right, earnings season's coming up. I need to be prepared. I need to put a lot of effort in. We'll talk about how the preparation method and all that type of stuff as well. But it allows you to sprint aggressively for that kind of 4 to 6 week period. And of course, some of the earnings are more important than the others. We'll talk about that as well. And then you kind of back off a little bit. Then you can review, you can reflect, and then you can come in again in April and do the same thing. In July, the same thing. Also, so you get those 4 kind of big sprints that last maybe a month or so, let's say. So 4 months you're aggressively on, and the rest of the time you're off. And that might suit you. That sprint then rest workflow style might suit you. And as I say, complement your existing kind of day trading or swing trading or run of the mill stuff, hitting the singles, and then you go, okay, earnings is a different strategy that I deploy, and specifically, not all the time. We'll cover the differences between the two in a moment, but maybe you're looking for those higher RVR trades. In other words, you're risking less. You're trying to risk, 1 to make 5, 6 to 10 type of thing. Maybe that's how you look at earnings. So it's something to consider. And now, especially Pepperstone offering a lot more US shares, it sort of opens the door to being able to trade this. Before, you could only really trade it directly. You had to have a kind of direct to market account, trade directly on the NYSE or the NASDAQ, and all the stuff that goes with that. Now we have the ability to trade some of the earnings. Not everything's covered, but some of the main ones are definitely covered. Okay, so it's be a nice place to specialize. So we can talk about after hours trading, trading the actual release, super high risk, but I'll share it with you. It's up to you whether you want to play that game or not. The 1, 2, 3 day trade opportunities, I like these. And efficient opportunity scanning. Okay, so let's get straight into it and talk about the reprice. So trading the reprice to me is really high risk, really, really high risk. It moves fast. You've got to be super, super careful. Let me describe a reprice to you. Some people call these different things, and there's a trader, I forget his name now. He calls these, what does he call these? Episodic pivot, something like that. I've always called these a reprice. It means the same thing. Basically, what happens is like a binary event, like earnings. Like I guess sometimes we get fed, changing the interest rate on a surprise. But let's talk about earnings. That's what we're focusing on today. A company is worth X. Now, fresh news comes out that makes the company worth 1.2x or 0.8x. So the market cap is, say, 1 trillion, for example, and now some news comes out that people believe makes the company 20% more valuable or 20% less valuable. I'm making extreme examples there, but you get the idea. It's a binary event that actually reprices that asset based on that news being released. So it could be an earnings beat, it could be some contract they've gained, it could be that there is some court case that has now been resolved, or it could be some litigation's been resolved. It could be any of this stuff. And by the way, we don't have to be an expert in fundamental analysis to do this. We're not trying to be economists, and I'll kind of get to that in a moment. But we just need to understand that this is what's happening. If you think about how institutions allocate capital, if we talk about people who are investing, by the way, not kind of funds that are kind of quantitative funds or doing anything kind of fancy, they're basically saying, hey, this earnings cycle is improving, or this earnings cycle's changed, or something shifted. Let's allocate assets to that and let's hold it for X number of years. That's why we get these moves. Earnings drives institutional money flow, and we get these cycles of missing or poor earnings, and all of a sudden things change. We get beats, we get misses, get announcements, get comments. Stuff happens. It's a very, very important point in a company's calendar when we have these 4 earnings periods throughout the year. We don't need to be an analyst. We just watch price. Price tells you whether an earnings has been good or bad to a general extent. I'm generalizing a bit because sometimes we get fake outs and what have you, but to a general extent, we don't have to overanalyze things. We can just look at price and determine how we trade based on price with some assumptions based on what's happened over earnings. Okay, so one sort of caveat here is to not force this, ladies and gents. Be super patient. Honestly, if you force this sort of trading style specifically, doesn't take any prisoners. I think it's super rewarding, or it can be super rewarding, but it's super punishing if you are forcing things. Be patient, anticipate, don't react. All those things that we know we need to do as traders, and planning is everything here. We can plan our trades, we can plan what we're looking for, we can get prepared. That's why I think it's such a nice strategy to deploy. You can do a lot of planning beforehand, and then no matter how, depending on how you kind of want to play them, you can then plan how you're going to play the earnings even afterwards. Unless you're trading the reprice, which we're going to cover in a moment, you can really kind of think carefully about your earnings system. Oh, one final point here. If your discipline is less than it should be, like if that's something that you believe is a bit of a challenge to you at the moment, then slow things down, because earnings will it'll elicit the response of FOMO, of breaking rules, of all the stuff that we know we shouldn't be doing. So if you're a trader who's developing and working on discipline at the moment, that's fine, that's okay, but leave the really high frequency aggressive stuff on its own. What's something just changed? Something just come up and changed on my screen. What was that? I don't know. Hopefully you can all see me. If you can't, then let me know. I had some sort of weird message pop up then, but fine. Okay, so don't force this. Be patient, anticipate, and just be mindful of that discipline. Just be mindful of that discipline. Okay, so what's the strategy? So this is the reprice. Let's go back, and again, this is if you really need to be very mindful of this, be very cautious. So the reprice is basically an impulsive move in one direction, right? And we talk about why a reprice happens: institutional money revaluing the assets. Okay, so it causes an impulse move in one direction, and the idea with the reprice trade is we're positioning for a continuation of that move. So We wait for the impulse, we wait for a pause or pullback, and we trade in the direction of the ignition candle or breakout. Loads of chart examples coming up in a moment. So, but it must retrace or pull back. And if you watched any earnings release, you know how it goes, right? Sits there and bang, just suddenly rips off to the high side. And we don't want to be chasing this. It's the last thing we want to do. Let the gamblers do that. We want to be strategic and say, we need to see a retrace or a pullback. Why? There's two reasons why, two big reasons. And if it just rips off, then fine. But waiting for that pullback is so important. One, because you minimize the potential for a V-shaped reversal. Often we see earnings go bong to the stratosphere, come straight back down again, and it's just a complete chop fest, right? We don't want to get caught in that. So we want to see the pullback, see it pause, and now we can also implement the trade and we can position our stop more effectively. That's key. So examples, Meta. So we look at Meta, and I believe Meta's offered 24 hours, by Pepperstone. So it's a great kind of stock to be looking at, to be watching during the next earnings cycle. And that's kind of why I'm doing this as well, guys. This webinar is appreciate we're coming to the end of this earnings cycle now, but it now gives you a chance to be prepared and build your playbook up, build your basket of stocks that you can access via Pepperstone. You can do this stuff and go, right, now I'm prepared. Now I know when these earnings are. Let me build a playbook, an idea of how I'm going to trade these things. So Meta earnings release came out. Not good news. We don't care ultimately about what the news was at that point in time. All we care about is the price response. And the price response was up near $500 and which went straight down to 450. Okay, so we're waiting. If it snaps back up, we're not interested. We're not interested in trading noise. We're interested in trading this reprice scenario and saying to ourselves, okay, we believe now that the price has had chance to bounce back up. It's flagging, it's just sitting there, it's consolidating at lows. The next likely move is going to be to the downside. Now, admittedly, and this is real world, right? We're not just going to cherry pick great stuff and go, oh, look at this. This didn't have a massive leg lower on that second leg. It was only later on in the evening that it actually had that really big leg lower, and there was your kind of opportunity. But the earnings release came out. We had the impulse, we had the retrace and flag, the little pause, and then we get a second leg, a longer retracement. And again, looking at price action, if you're a price action aficionado, which I think we should all be, you're saying, okay, listen, price isn't responding. Buyers aren't stepping up here. No one's really that interested. The next likely move is going to be lower. And why we wait for the retrace? Because we can position our stop. If we're trying to jump on moves like this, if we're trying to be clever, we're trying to be smart, you're just going to get hammered. You're just going to end up selling the low, buying the high. It's just let the move play out. Let everyone else scramble around. Let everyone else scrap about and say, right, hey, let's just let the move play out. Let me see how it responds. I know how I'm going to react. Now I know where to put my stop. I know how I'm going to position. I'm looking for an ignition bar. I'm looking for this, and this. You can be very, very calm, and you can trade something that's actually quite a violent and aggressive move in a calm manner. You can be that calm guy. And also that meme, that time, there's a guy in a kebab shop in the UK, believe it or not, and there's a massive scrap going on. This guy's just sitting there, mid-40s or something. Is eating his kebab, and there's just chaos going on along other side of him. People are fighting. This guy's getting kicked out, and he's just sitting there, and he's just like enjoying his kebab after he's been to the pub or whatever it was. And that's a bit like that, right? We just want to be in our own little world, let the chaos go and say, listen, I'm just going to execute this. I'm not going to do anything else but eat my kebab. Awful analogy, but you get the idea. Okay, so let's just dissect exactly what's happened. So price dropped heavily, hard, bang, aggressive, slamming it straight to the downside. That's a big move for a big market cap stock like Facebook, Meta. Something's up, game on. Okay, good. We wait. Will it V-shape on us? Will it retrace or digest? Look at the action. Aggressive move to the downside is 1 minute candle, by the way. We're sitting, we're waiting. Is it going to V-shape? No, it's flagging. Okay, that means that we can now potentially structure a trade. We want to trade in the direction of the impulse move, and we can put a stop above a sensible level. And you guys know this. Like if we're doing this, we're going to put a stop above there. And a stop loss always has to be in a position where it negates the trade idea. And the trade idea is, hey, I think this is just getting started. I think we've got a lot more downside to go here. The price action, the earnings release is indicative of that. The subsequent price action is supporting that. I've got a place where I can express the idea with limited downside, i.e. stop above that 450. Okay, game on, there's a play. It's very structured. It's very, very methodical. yes, we are, this is a bit more of a risky environment, but ultimately we're de-risking it a lot by adding that stop loss in that position. Okay, loads more examples. Let's keep going. Google, same type of thing, right? We had the spike up. And by the way, these little spikes here that you see, there's one here, and there's a few more, these rogue prints. There's rogue prints that come through. If you ever watch kind of on the order book, you sometimes get these delayed rogue prints. These isn't actually a genuine print. So some of those happen sometime in earnings because of the way it works and the ECNs and stuff in the actual direct access market. You can forget about those. So spike up, Alphabet, Google, bang, up it goes. Waiting for the retrace, waiting for the retrace. There's a little bit of support here, and you finally get a second leg. So it's the same type of things, a reprice scenario. We're trading very quickly, very aggressively, looking for that continuation momentum. Let it tip its hand, let it prove that it wants to stay at that level, and then look for the next additional leg. Admittedly, not much in this, but I'm just showing you real life examples that happened, recently. The most recent earnings, and always going to be winners, and always going to be fantastic. It's brilliant trades, but if we can cap the risk off, we can play the game. We can just keep hitting the singles, taking a small loss, and then eventually we want to be on the end of one that actually runs and runs and runs. And I'll show you some examples of how we capture those and position for those in a moment. But trading's about managing the losers, right? You know this, I know this. It's all very well to sit here and cherry pick these great trades, and it's going to do this and do that. But ultimately, it's a game of just keeping yourself in the flow. Just keep yourself in the game. Not any dramatic losers. Just keep yourself in the game. And then when you get on the end of something, it's pushing that throttle down. It's trying to get the most out of that movement. That's what we're trying to do, and that's generally the earnings procedure. That's the playbook we're looking to do. Okay. So we had this type of thing on Google. This is a slightly lower time frame. That was a 5 minute. Put it down to a 1. You're looking for some kind of support. So a break of this on ignition bar. I've talked about these before, guys, but not in the earnings context. Ignition bar break, great. You've got the reprice. You've got the consolidation. It's the opposite of Meta. It's accepted this new high price. Whatever it's said, whatever's been said, who cares? We know it's been accepted. We know the next likely move is going to be back up to highs. We don't know how far this goes. It didn't go ridiculous, but the point is we can structure the trade with a quantified risk. Risk is going to go below that low. Perfect. We can have a go. What's the worst that happens? Comes and stops us out. We accept the risk on every trade we take anyway. No big deal. Okay, so day 2 plays. I quite like these. I have to admit, these are okay, right? If you really like trading aggressively and you like getting involved in the very, very short-term action, and you happen to be at the screen at the time of night, and it suits people who are working perhaps during the day, you come back, you structure your earnings play, you say, hey, earnings most of the time are going to be released after market close, so it's going to be after 9 o'clock. You can be prepared, you can be ready. And if you're the type of trader who likes to take advantage of potential opportunity on these earnings plays, as I say before, now you get access to many, many more stocks with Pepperstone, so you can be positioned and ready to say, hey, I know Google is going to release this time. I can get myself for Alphabet. I know I can get myself ready. I can get myself prepared. I know the trade I'm looking to take. It either sets up or it doesn't. Now, let's move on to day 2 play. So this is where I think it gets more exciting and more interesting. So if you don't want to trade the earnings release, or you can't for whatever reason, these 1, 2, 3+ post earnings movers offer, I think, good opportunity. Again, we'll show how we can limit risk because that's the name of the game. Just keep the capital, not doing much damage to the capital, and then when we get the real opportunity, that's what's going to hopefully make the playbook work. So here's something that you can go and have a look for yourself. Key levels from the overnight session, i.e., when the earnings are released, offers really big clues. Really big clues. I'm going to give you some examples in a moment. And if you want, go and have a look for yourself. Go and see how many times a level that came out during earnings actually played over to the next day. So if you don't want to trade the earnings release, you don't have at 9 o'clock trading this, maybe you want to trade the next day after the next open, so 2:30. You can kind of do your analysis in the morning, draw your levels on, and prepare. Again, going back to that initial slide, preparation, planning we're anticipating, not reacting, and you can structure a way to play there. So you're using the volatility of earnings and the kind of institutional money flow, money's coming in, hopefully either staying in or it's coming out, it's staying out. You don't want that two-way trade. You want that kind of, structured move that holds that reprice we talked about, using that and saying, right, I'm going to trade that. I'm going to use the data I've got from that, all the information about what the levels are and stuff. I'm going to trade that the next day and the next day and potentially the next. There's some great examples for you in that. Just as a side note here, if you're trading on TradingView, you just change the on the bottom of your chart, it just says regular trading hours or extended trading hours. I've just got that there. ETH is extended trading hours. You just click that and then change it to regular trading hours. Extended trading hours gives you the earnings, the 24-hour session, or the session that's in there's volume there. And regular trading hours does the 2:30 till 9 if you're in UK, kind of general bing, ding, ding, bell, NYSE type stuff. All right, so going back to Meta, look at the levels. And I like to draw kind of boxes, just personal preference. I think that, it's easier to kind of get an idea of the level of interest, the zone of interest, the area I might consider doing some business, as opposed to a strict line. Doesn't matter so much. You can still visualize in the same way. But look what we've got. Earnings comes out. We've got a real decent level at 430. Okay, because it was support for a while until it broke, and then it became resistance. So 430, significant. Mark that on. Many of you were proficient in drawing support and resistance levels, support and resistance levels. And then 410 was the floor. Couldn't go much below that. A little bit of a spike on that kind of move there, but I'm going to say 410 because once it popped back up, it didn't go below that. So now we've got two key levels, okay? And that all happened during earnings. By the way, you can analyze this after the fact. You have to be doing it right now. You can look at any point from kind of midnight till the next day and say, oh, you know what? Actually, look what's going on overnight. Okay, so we mark up our charts accordingly. We get prepared. In fact, I think I was sliding the wrong position there. But look what happened the next day. So day one, this was our 430 level. And this is our 410 level. Price at the open, this is the opening bell here. It's changed from this kind of yellowy color to white, 230 UK open. What did it tag? Straight down, tag the bottom of that box, top of that box, should I say. That support level from overnight. If we go back and remember where we were on that, scroll back. That was the support level from overnight. The 410, 412, bang. It's a beautiful level. Came down, first 10 minutes, tagged it, and then just bang, catapulted straight back up. Where did it stall? It stalled at that point in our box, eventually ripped through, came back. You can see how significant that level is, especially at the open. And that's the key. It's like, yes, it does sometimes play through to day 2, day 3, day 4. But the play that I kind of want to frame for you is you mark off your levels from the earnings release and overnight session, and you use those to potentially trade the opening hour, the opening 2 hours the next day. Now, if it starts to adhere to some of those levels and they become significant, then you can extend those out for day 3, day 4, etc. And you just see how often they come into play. So that's Meta. Let's go back. What did I say on this slide? Okay, so yeah, I just wanted to reiterate this point. The big levels that form in that extended trading hour session are often in play for several days. So kind of an operational thing here, mark up your charts accordingly, get prepared, and back to that same thing, guys. Just anticipating, don't react. We don't need to be like a headless chicken trying to find out what it's going to do. We have a level, we have another level, and we say, hey, if price touches this level, I want to get long. If price touches this level, I maybe want to get short. Or what you can structure your trade and make a decision based on some of the data you have. So let's look at something. Day 2. So that's next day after earnings. So we had the open, earnings, open. The next day after that, day 2. Guess where it came down? Came down to a level that had formed in the earnings session. So we're going back like 48 hours now. It's still valid. Why is it valid? Because institutional money is sitting there going, I want to buy Meta at 430 or 430 to 434, whatever it is. Again, we've got to use the zone here. And it holds all that way through. And then you go again, look at day 3. It held again the next day. So earnings, day 1, overnight, day 2, overnight, day 3. We're talking a lot later. And then look how important that 430 level is. Held on that open. Again, the open's so important. So important. There's a little bounce traded off there. Finally broke through even after finding a little bit of support. Came back up. Support turned to resistance. The old game. So is it always going to work perfectly? Of course it's not, but it's something that's very interesting. And if you mark off those levels, not a complicated thing to do. How long is it going to take you? You mark off your earnings plays, you mark off your levels, and you go, right, now I'm prepared for the next day. Okay, look at Netflix, another example. Great example. These are all earnings that just happened, by the way. This isn't stuff I've gone back and gone, oh, let me find something from 1904 that matches the idea. No. This is stuff that's just happened. So earnings came out on Netflix, a bit choppy. So maybe not the reprice scenario trade that you like. Some people might argue, oh, I could trade that, but not for me. But there's a massive level here, massive level at 579. I've drawn it. I could draw it the perfect line on this one, 579. So I'd probably have if I was trading this one, I'd probably have a kind of, couple of dollars either side of the level rectangle, so I can notice the zone. Resistance formed, so it's drifting down overnight. That was the close. Earnings came out. Not very happy with the earnings. It's trading at 610 now. It's trading at 570, and you can be prepared. You can be prepared, and you can say, right, yes, this one of the stocks that's offered? Yes, it is. Great. Go to Pepperstone account, get myself ready, put my level in. Okay, 579 is a big level, and same type of game, guys. The same type of game. Right at the open. Where's the high of the open? The high of the open is 579. It's exactly the level that was formed during that extended trading hour session. Is it always going to be like that? No, but it just allows you to get yourself positioned and prepared for that opening shenanigans. While everyone else is messing about trying to work out, is it going to drive low, is it going to do this? You can say, listen, I just want to get short on that first tag. If I get that in the first 30 minutes, I'll have a go. Use an ATR based stock, quantify your risk. You've got opportunity there. And it's about creating these asymmetrical risk reward opportunities, high probability plays. It's about doing that in trading. It's not about trying to get every trade a winner. It's about trying to do that over time. And if you trade the earnings season, your playbook is I trade 4 times a month. And I look to trade I kind of refocus 4 times a month and I trade the bigger earnings that are moving. You've now got a system that you can repeat and repeat and repeat. And are they all going to be like this? Absolutely not. Absolutely not. But you have something to work from. And many people, I believe, struggle trading earnings because the volatility is quite seductive, right? You see the price swinging around and you go, oh, it's going to do this, it's going to do that. And you reinforce your bias and say, I think it's too long, it's going to bounce, it's going to do this, it's going to do that. And you start to look for trades that are doing this and you get caught out. So the trick with earnings is to let price tell you what's happened. Say, hey, what's happened, price? Well, I didn't like what's happened. Don't worry about digging into why. Just look at price. Price is telling you that the market does not like what Netflix has said. Who cares what it is? Is it subscribers? Is it password sharing? Who knows? Who cares? Let's just watch. You've got your level. Just let the data tell you. There's a level there. I can trade off that level. Okay. Let's keep moving. We've got more stuff to cover. Q&A, stick your questions in if you like to. I will get to those at the end. Okay, so what's important? So with that chart, Netflix tested that key level early on in the regular trading hour session at the open and then melted away. It did finally rally on day 2 and 3. And this is sometimes you think, wow, it's absolutely perfect. Look, so there's the day we just had, melted away, finally got a bit of a bid coming in. And where did it stop? Where do you think that stopped? Why is that level important? Who knows? But look at it. If you're prepared and you had the level there from that extended trading hour session during the earnings release, and you knew that it was key, look, it still comes into play 3 days later. It still comes into play 3 days later. Now, would you have shorted that and hoped for a gap down the next day? Maybe you wouldn't. In the real world, maybe you wouldn't. But just to point out, look how useful being prepared with those levels is. Okay, another example here, Alibaba, they have not low held and was a springboard. So look at this at the open again. It's the open. These are the things I want to stress to you. The level, get the reprice. So look at some sort of reprice scenario. Alibaba here, reprice to the high side. There wasn't really a reprice scalp trade that we talked about earlier, but the level is very clear. 82.60. That's the low. It's staying there. It's not going any lower than that. It was the print here. That's a good level to have. And then next point, at the open, very often we test that level before moving off. And this was just such a little beauty. It came down, tagged it, and it was off. And kind of if you were just day trading that, you had a 1 day play. Very, very nice way to trade. Okay. So how price behaves around the levels gives you the clues. So does it hold above the level? Does it hold below? Don't forget those big round numbers and the gap as well. There's always that earnings gap that very often might be filled later on down the line. Let's look at Microsoft. So this is kind of flipped and it's slightly on its head, but it still makes sense, right? Your 412 level that you had from the overnight session is there. Great. Now, maybe 412, 413, but you can see how you draw your rectangle. We actually opened and rejected that straight away. But we came right back up, tested that level twice before peeling back over. It's a key level. Now, you might say, hey, but Mark, listen, pal, it's the opening print as well. Yeah, I appreciate that. It is the opening print, so there is some confluence there. But you can see how being prepared by just doing a little bit of technical analysis on your earnings kind of data release is going to help you loads. Okay, so now next day, we're kind of going on a slightly different level here, but I kind of wanted to just highlight the point that price really gives you clues. So we kind of closed at lows. Next day, really big opening drive to the downside, and it got stuck there between that 400 level, the psychological whole number level, and 402, just a random level. It just got stuck there. And think about what it's telling you. That's telling you, hey, price is rejecting. There's no value. If you think about, how the auction process works, when price moves lower, buyers should get attracted and go, "Ooh, I can buy a Microsoft now at $400 a share," and it was trading up at 412. Oh, that's a bargain. It's a big company. I like Microsoft. That's how people are thinking. But if they're not buying it, or if it's not rallying straight off, it means that the sellers are still thinking, "I want to dump Microsoft at 400 a share. I don't want it. I don't want it." And so thinking about that auction process and supply demand imbalance just helps you. So next day, again, that's why the open's so key here. Look how important the open is after earnings. We had that tag of 412. We had a drive low that just literally just dripped through that low. And then the next day, we rejected that 400. And what happens? It just holds below 400, really bad for the stock, and just got hammered to the downside. There's your 3-day plays, the 1, 2, 3. There's your focus. And the good thing about if you're trading earnings or if you're building an earnings playbook is that you can say to yourself, okay, if something is starting to form like this, I will look at it in day 2. I will look at it in day 3. If it starts doing all sorts of stuff and not adhering to the level, or you get stopped out, you go, it doesn't matter. There's plenty more earnings plays to look for. And I kind of show you how to prepare. There we go, there's a slide. Good. Preparation is everything. So to get on board those and to be able to do your analysis, you just need to be aware of what's reporting, what your process is going to be. How are you going to identify the best opportunities? Because you can't catch everything, right? You just cannot catch everything. And that's another thing that perhaps I should have said at the beginning is so many, when you're in the thick of earnings season, it can be overwhelming, right? You just have to mentally prepare that you are going to miss some really good trades. That is the way it is. What's the old Chinese proverb? Man who chase 2 rabbits catch none. Well, man who chase 5 earning stocks loses on all. Is my proverb, because you just can't focus. You need to pick your opportunity. You look at especially if you're trading the day 2, 3, 4 plays, you can screen quite nicely, right? Because you can look at what the earnings or the bigger earnings plays and the bigger movers. You can, at your leisure, before the next open, you can go through trading views, say that's interesting, that's not. Just scroll through your charts, put those in a watch list. You double check the Pepperstone off of those. Great. Okay, I can trade that. That. Okay. Now I want to put my levels on. Right now, which is going to be the best opportunity for the day, and you kind of look at it and play it that way. So you can't catch everything, and then you're obviously deciding how you're going to play that. A couple of more chart examples here for you guys. Shopify. Again, these are all kind of rogue, erroneous prints, but there's no real effort to buy the discount. I talked about buying the discount on Microsoft before. You think about it, just think about what's happening. If there was a house in your street, right, and all of a sudden it was perfectly fine, there was nothing wrong with it, and it suddenly went on offer for 20% under the asking price. It was absolutely perfect, absolutely fine. The survey was good, it was all good. It would be snapped up in a second, right? Because there's no reason why it wouldn't be. It's just a discount. It's a huge discount. But if that house had subsidence or it had something, I don't know, something drastically wrong with it, then no one's going to really buy that. They might buy it. They might be like, "Oh, yeah, I think it's worth it," but it's not a bargain. And that's kind of the way to think about when stocks are repriced in earnings. If people are perceiving it as a bargain, then great. They're going to scoop it up. It's going to probably rip back to highs. But if they don't, that's telling you something. And when price sits at lows or highs after an extreme move, watch for a continuation. That's a general rule of thumb that often works very well. Now, Shopify was a bit of an awkward sod. It was a bit tricky because it sat there for 2 days doing absolutely nothing, sat within that $3 range or $2.50 range doing nothing. The likelihood is it's going to resolve to the downside because the buyers aren't there. But the longer it stays there, the more you kind of get less excited about it. Anyway, it did eventually resolve to the downside. But going back to the earlier point, if you're prepared and your preparation is key and you've got your level, you're like, hey, there's my pre-market level. There's my level that I actually had on day one, day two, 61.49. I'm waiting for a break of that. Finally, it broke and finally it got going, and it was a huge trend day to the downside. That final buyer that was sitting there scooping up all that stock, it was done. It was filled, and it just crumbled down and ended up trading down under $59. So it's the preparation. I use this as an example, is that it's being prepared. Your levels in and being prepared, and sort of highlighting the fact that these 1, 2, 3 day moves after earnings can be so lucrative if you're prepared. Of course, they don't always work. Of course, you might get stopped out. Of course, of course, of course. Yeah, that goes without saying. But if you want to be someone who specializes and build the earnings playbook, it pays to be prepared. It pays to be structured and understand and use those pre-market levels as a kind of guide. Okay. So we talked about how to use the levels from your extended trading hours session, bring those over to day 1, 2, 3. Let's talk about 1 to 3 day swing trades. So you don't want to day trade, you want to hold things for a little bit longer. And that's fine. I think that, you get you can potentially get some really big movers from this. And it's like playing that game, right? It's like fishing. Um, I'm absolutely an awful fisherman. I remember fishing during lockdown. Was I allowed to? Who knows? I remember fishing during lockdown. And honestly, they literally could see the fish there and they still didn't bite. And I was thinking, man, I'm lucky. I'm a better trader than I'm a fisherman. So bad analogy, but a really bad fisherman. Anyway, but it's like fishing, right? You cast out your rod, you wait, nothing, you wait, you wait, you wait. Eventually you get on something and you want to haul that one in. It's a little bit like trading earnings, right? Sometimes it's going to stop you out, sometimes going to stop you out. I'm going to show you kind of a pattern that often happens with these stop outs. And there's sometimes you get on one and it's a monster. It's like, brilliant. That's what I was trying to play for. I just needed one of those per earnings season, and that pays for the losses and recovers and gets me back to where I want to be. All right. So institutions build or offload positions. We discussed that. What do we look for? Gappers that hold at lows or highs. Had some examples before. Good earnings that beat a surprise, some kind of surprise. Again, we don't have to be an analyst about this. We can tell. Price normally tells us. It's normally pretty clear. If it's a big bullish news and everyone's happy about it on the street, then what they're going to do, they're going to buy the stock. The stock's going to hold at highs. It's going to be repriced, and it's going to stay repriced. Here's one thing as well, a little tip. Well, not tip, something I like to adhere to. I'm buying earnings long in a bull market, short in a bear. What do I mean by this? So be very, very careful about shorting earnings misses in a bull market, especially if the stock has been outperforming generally. So context is key. I've talked about this a few webinars before, and hopefully you kind of take that on board. But understanding context, right? If we're in a rampant bull market and the stock is super, super bullish, an earnings miss is probably going to fill the gap. We won't talk about gap fills today specifically, but I wouldn't be getting too excited about shorting a gap lower in a bull market with a stock that's been outperforming. Right, you're just asking for trouble there. One earnings miss, unless it's really, really, really bad and there's something horrible going on, which generally is not the case. It's probably going to unwind back or at least stagnate. Not always, but that's kind of where I look at it, and vice versa. Right, I'm looking for earnings in the direction of the move, in the direction of the underlying context. That's a good general filter. Unless you're going to day trade stuff, that's fine. If you want to day trade stuff like a Shopify short, and you say, hey, listen, I just think it's a break of key level. I think there's 4 or 5 hours worth of trade on this. Then that's different. But if we're talking about these 1 to 3+ day swing trades, align with the sentiment, align with the context, align with the market trend idea. So trade setup idea, very simple. Again, use as a seed of an idea to go and explore yourself. We enter on the close when we've had a big gapper. So we've had a big gapper move and we've had day one kind of play out and we've seen it kind of hold that level. And we enter on the close and we use a stop on the earnings day low. And the idea with this theme is we're going to take lots of stop outs. We've got to be very disciplined. We've got to be very, very mindful and not get frustrated. It's one of those strategies that you have to be able to stomach loss, because the way the maths works on this is you're looking for that what I call jackpot trade. You're looking for the trade that actually this earnings just changes the company massively. You're in on day one, you've got your stop, and it runs and it runs and it runs. We'll show you how to manage those or ideas of how to manage those in a moment. There's a low hit rate, high risk reward ratio. And that might be not for everybody. I appreciate that, because it's sometimes you're like loss. You don't want to keep trading it. But the idea is that the one makes up for many losers. Okay. So, oh yeah, I've added this slide in here so we can think about it as we look at some examples. So managing these, and again, I've gone a very specific rule-based approach here. You implement what you see is the right structure for you in the way that you want to trade this. I've just kind of given you some ideas. And again, I don't have all the answers, absolutely not. I'm just sharing with you things to explore and look at further. So a good way of managing these, and this isn't the only way by any stretch, right? There's many, many ways, and probably better ways that suit you. But a good, simple, methodical, systematic way of managing these is you just say, hey, I am just going to hold this until the prior low breaks. So, example in a moment, but let's make some patterns in the sky. You've got a bullish candle, a green candle. Your stop goes under that low. That's how you initiate the trade. You enter on the close. Your stop goes under the low, and the next day you move your stop under the next low, and the next low, and the next low, and you just play that game. And you go, I don't know where you're going to go, stock. I just want you to go to the moon, and if I'm on for the ride, that's great. And if you come back and if you reverse and ping me out, then that's the way it is. And something to point out here is, and then maybe you can adjust the strategy from this. That'd be interesting. But sometimes he's just pinging you out on day 4. It just happens like you get that 1 day move, 2 day, 3 day, and day 4 comes back and pings you out. And often that's enough, right? That's enough. You get paid a little bit for the trade. But sometimes that's going to stop you out because of the nature of the beast. And we'll see some examples. Sometimes if it gets really going, then you get that, what I call jackpot trade. And you have to choose your thesis. I think it's worth mentioning this. If it's company changing and you believe, hey, wow, the company's paid off all its debt, or they've resolved this court case, or something that you kind of understand about the company that's really changing. Many years ago, on the 3D printing company, they paid off all the debt, they restructured it, and the thing just rocketed. But if you understand that and you say, right, I'm going to let it breathe. I don't want to just come out on day 4. I want to get in. I want to kind of pull my stop to break even and see if I can get an absolute monster from this. And if it comes back and stops me out, so be it. Or if you're playing momentum only, then maybe you want to drag the stop up under the prior day's low. I have to say, for me, very rarely am I going to say, oh, I just want to let it breathe. I want to play momentum. I don't pretend to know more than the analysts. I just want to say, hey, if I can get on day 1, and I believe the institutional money flow is going to flow into this, and it's good, I should just ride it for all I can. And that's the kind of the way I play it. But it's up to you, all right? Oh, and one thing to mention here is obviously overnight stock holds have extra risk attached. Talked about Pepperstone offering the 24-hour product. Obviously, the spread's going to be a bit wider. Things are going to change over that overnight session. So just be aware of that. Understand there's a little bit more risk. And if it's not available overnight and it just opens the next day, so if it's a stock that they have available but just in a regular trading hour session, just understand that when you close the trade, when the market closes, you can't do anything with that trade until the bell opens. Unlike the indices, unlike your Forex pairs, where you have that 24/5 access, you don't know what could happen. And also just be aware that around earnings, other news can come out. So you do have some gap risk. As long as you understand that and appreciate that, you're good to go. But just recognize that there is a little bit higher risk involved in trading stocks that have a closing bell and don't open until the next day versus trading something thicken like USD JPY or NASDAQ or DAX or whatever it is. Okay. So that is an interesting one. Root. If you were deploying this strategy, you would have bought it here. You stop below the low. And this, admit it, I don't normally cherry pick, but I cherry pick this one because I remember it happening and thinking this isn't a monster. This has to be in this webinar. It absolutely has to, because I want to show when things get going, they get going. And if you use that simple approach, you'd be buying at the close, which was whatever that close was. Oh, the risk was 180. Whatever the close was. I don't know. I didn't mark off the close. Anyway, something like, yeah, someone can work that out. Public maths is not my strong point, but you're buying at the close, your stop's below that low, and you ride it. And you ride it because you just have a stop below the low. So it closes here, you put a stop here. Closes here, put a stop here. Here, 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 here. And eventually you get stopped out as it breaks this low here. So it breaks this low here. And you get stopped out at 41.68. That's a big move. That's a rare move, admittedly. That's a really, really rare move. But I want to show you that these moves do happen and why we're looking for the so-called jackpot trade. You've got $1.80 risk. It's gone from 11.50. It's gone from whatever it was, $12, $13, let's say, up to 41. That's a big risk reward ratio result. Thank you very much. Rare. Let's understand that. I think you know this, but these things can get rolling. Okay, so one that had sort of two in a row was this sweet green. So same type of thing. You kind of bought it on here. Your stop goes there. You drag your stop, 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 goes up. Eventually, you get stopped here. $25. That's a decent risk reward ratio again. This when we get into some of the real world stuff. Very often, day 4 kind of will stop you out if you're looking for this trade. So if you took the same play again, your stop was here, your stop was here, your stop was here, you got stopped out here, and I think it's basically break even, right? Because your entry was here, your stop would have been here, and you're dragging up. Now, this is where sometimes you're in this trade, you see this monster move, and you have to have that stop there, and you have to go, oh god, that's quite a bit of unrealized to give back, right? If you're in here and all of a sudden it's up here, that's kind of 30%. But again, up to you how you choose to manage that. But when these things get going, they can really get going. Nvidia, which we have got tonight, I think we've tonight, isn't it? Is it my date's right? I think pretty sure, almost 100% sure. Never be 100% sure on anything, but I'm pretty sure it is. Same type of thing on here. You bought here, kind of just didn't get going. Day 4 pinged you out under that low before it finally got going. That's the nature of the beast, right? When you play this game, you got to manage the risk. Got to keep a tight leash on those trades because they can just turn around. They can just rip the other way. And you don't want to be in that hoping and putting in investment draw. Don't play that game. Day 4, Pinterest, 1, 2, 3, 4 just pings you out. So just a small loss because the other loss is manageable. And when you go, okay, I don't mind taking this, a 32-cent loss, a 38-cent loss on a $900 stock, pennies. But if you can get on something like this, it makes up for it. And that's the game you're trying to play. Right? It's a game you're trying to play. Okay. So how to keep track. So Pepperstone, you follow these guys on Twitter. They have a really handy week ahead for financial markets that just kind of consolidates all the important earnings. Because if you go on some of the bigger sites, they've just got a sea of earnings. And you're like, man, there's hundreds of stuff. You're like, what do I look at? I don't know what to look at. And accept you're going to miss stuff, but just paying attention to the things that are important. So, whoever's running the Pepperstone Twitter account, good one, they're filtering out the stuff and saying, hey, listen, after market close, you've got Cisco to worth watching. Before market open, you've got Walmart, you've got Baidu, you've got John Deere, you've got all. You can look at these, and this is towards the end of the cycle, so there's not so many. But when you look in the beginning of the cycle, in the thick of the earnings cycle, you're going to see, hey, this is a really good way of just filtering out the stuff that people care about. Now, you can do more, you can find more. Of course, you can, but it's a good place to start. TradingView screener. So if you're playing in the day 1, 2, 3 type plays and not the reprice, I would say you could use the reprice. TradingView allows you to screen for earnings that are out now. It also allows you to screen for companies that have earnings and have had a big gap move. So you can do that, and you can kind of see, hey, is this? And then you've got to do an extra check to make sure you can trade that product, the Pepperstone, off that product. But that's fine. You can do that, and if you screen on market cap, it's going to be pretty good. FinViz has got a great screener on it. If you go on X, Twitter, StockTwits, they will kind of always covering earnings. So the process is you get your earnings, movers, you mark up your levels, see how important those levels are during the earnings process on the extended trading hours. Find your best ideas, get prepared, be prepared to miss most. Look at the daily chart context. I mentioned it briefly, but hopefully with enough kind of conviction to say context is important, relative strength is important, relative weakness is important. The trend's important. Is it company changing, or is it just another day at the office? Is it just a nothing earnings release, or is it something that's really significant and everyone's gone, oh my God, that's really, really bullish, or oh God, that's horrible, and is get out of the stock? So it's worth just kind of just having your finger on the pulse a little bit. And that is what drives the multi-day plays. Not the little beats, not the slightly more than expected, not this, not the that, not the all the kind of that, but the big stuff. If a company was just one actual exception to the rule I want to point out is if a company has been battered based on some story, and then earnings comes out that flips that story in its head. So the trend is lower and lower and lower and lower and lower. And something comes out and says, "Hey, we've fixed this problem. We've found out how to." It was a little bit like with Facebook many years ago, monetizing mobile. God, that was many years ago. Couldn't monetize mobile. Couldn't monetize mobile. The street hated the stock. All of a sudden, they worked out how to monetize mobile. That came through in earnings. Company changing. Company changing. And so things like that, when it's something important, like they've restructured debt, or yeah, there's something that's been really dogging them down. That's the exception to the rule where context can be flipped on its head. And you can say that was the reason for the relative weakness. That was the reason that it was hammered. Okay, now that reason has shifted. Let me get involved. And so just understanding the nuances. Obviously with everything, there's always exceptions to the rule, and that's a slight exception there. But generally speaking, context and trend will keep you on track. Okay, we're doing good for time. Summary. Pre-market levels are important. Hopefully you've seen that now. Hopefully you get that and go, right, yeah, I get that, Mark. If anything else, I understand those pre-market levels are important. I can use those on my subsequent day 1, day 2, day 3 plays. Good. Look for the early test. Most of these tests happen at in the opening hour. So you've got your pre-market, a little kiss at the level, often rejection. If you're a day trader, that's what more does a day trader want? You prepared, you got your level, you see it, you can either stick your order ready in limit with an ATR based stop, or you can see how it behaves around the level. Up to you. Your call, your money, your risk, you play it how you want to play it. But that early test is often very important. Preparation, your plan of attack, how are you going to attack things? Look for those reprice scenarios. Whoa, company changing, this thing's moving massively. And the 1 to 3 plus day holds. If you're going to play that, then just here's something I would say. Like if you're going to play those, and I like those, I quite like those myself. I like holding for something that potentially is going to move a decent way. Have a very systematic way of managing it. Many people say, I'm going to look at the price action, this, and the other. You end up talking yourself out of a really good trade. If it's a genuine reprice scenario, if it's a genuine trade that's going to run, it's going to look like it's topping. It's going to look well extended, and your calibration when you're trading Nasdaq, when you're trading, cable, you're trading all this stuff is going to be calibrated to extension, spring stretched, comes back, contracts. You're going to be calibrated to that. That's a traders, right? We mean reversion calibration. These break the mold when they break out and they keep going. So I would suggest, and this is how I do it, and listen, you do it how you like, but think about having a systematic way of managing it, because they just look so toppy. They look like they're just going to turn and they will go and go and go and go. And the whole point of the strategy is that you're taking a little paper cut, little winner, little paper cut, little winner. And then you're looking to trying to get on that multi-day move and that runner. And that's your objective. And if you can focus that in your mind, you can be okay with kind of coming out and stuff. And then you need a really big reason to come out. And just a reminder, earnings season is at the end of the quarter. So January, April, July, October, it lasts for about 6 weeks. But like I say, if you're following Pepperstone on Twitter, or if you're just keeping a finger on the pulse, you're not going to miss it. It's all over the media. It's all over Twitter. It's all over all this stuff, what the earnings are and when they're going to come out. Okay. So a reminder, if you haven't joined my email list yet, please do. We're nearly at 10,000 now. So if you want to recommend it to someone who you like reading the daily emails, then please consider sending it to somebody, because we're nearly at 10,000. It's just that little magic number, which would be great. And as I mentioned at the beginning, do check out the new 24-hour CFD trading on select US shares, selection of US shares, should I say. That's a tongue twister. Selection of US shares. Pepperstone now offer a decent suite, actually, of stocks that you can trade all through the evening. Obviously, it spreads a little bit wider sometimes, but if you're going to trade earnings, that kind of allows you to take advantage of a bit more opportunity. So explore that if that's something you're interested in. Okay, so again, final thing to apologize for the tech issue we had last week. Hopefully, I've made up for it by putting jam-packed fire hose of information at you, and we are good for time. I can answer a few questions if you have any. If you haven't got them now, that's no problem. I've covered a lot of ground. You're very welcome to watch the recording. Pepperstone will absolutely send you a copy of the recording. If you have any questions, you can email me, support@Traders Mastermind. If you've applied to Pepperstone, I'm sure they'll send me the question. If I can answer it, I definitely will do my very best. Okay, ladies and gents, I think we are good. I will give it a second to see if we've got anything. But we've covered a lot of ground there. Let me go back and make sure we're good to go. I think we are. If you are watching this on the recording, then yeah, if you do have any questions, absolutely, you send them to me. Otherwise, take care. Have a good evening, ladies and gents, and I shall see you next time. Take care. Bye-bye.